A very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, Chief Currency Analyst here at HYCM. Just a very warm welcome to you, particularly if you're joining us for the first time. As an outline, we'll be going through a workshop today just to outline how we go about analysing a currency pair to trade on a day-to-day basis, also on a swing trade basis, and how we go about analysing where we want to be entering and the sort of factors that we consider. The idea of these workshops is that you're looking over my shoulder, someone with a professional trading background, and you see how I go about making decisions based on my professional experience in the FX, commodity and indexes. So that's what we'll be looking at. Just as folks are coming in, just saying a very good afternoon to you all. Just wanting, hi Salvatore, good to have you. Hassan, special welcome. Warren, Rajan, good to have you on board. The whole idea of these workshops, it's not that it's a signal trading service. That's what there's a disclaimer here. It's not an invitation to trade or a signal trading service. It's the idea is you look over my shoulder and you see how you go about making decisions. So without further ado, we're going to get stuck into the webinar. And in this workshop, the key aspect we want to do is we always want to trade a strong currency against a weaker currency. Just like in an arm wrestle, if you had two people arm wrestling, you always want to trade a strong currency, a strong arm. You always want to take on someone with a weaker arm in order to put the odds of success in your favor. And exactly the same way in the financial markets, we're looking to have strong reasons to buy or sell a currency against another currency which has the opposite impact. And in this way, by pairing strength against weakness, we can make sure that the odds are much closer in our favor. So we're going to get stuck in, and I'm going to go over to my other screen, and you can see here that I have the pound US dollar pair on the screen. Now, we have reasons for pound weakness medium term. The UK now has rising COVID-19 cases. We are having renewed COVID lockdown restrictions as the UK has gone from level 3 COVID alert up to level 4 COVID alert out of a possible 5 levels. So the UK is now one of the highest level of alert. We also are approaching the end of the UK furlough scheme in October. That means that there will be no further support for those people who have been laid off temporarily from their work. We've also got the Bank of England who have hinted at negative interest rates to come for the UK. Last Thursday, the Bank of England met and they gave this idea of potential negative interest rates coming for the UK as the Bank of England instructed the Monetary Policy Committee to look at the implications of negative interest rates. Now, Bank of England's Governor Bailey did say this week that just because we're considering interest rates going negative doesn't mean we will put interest rates negative. Nevertheless, money markets are pricing in negative interest rates in February next year for the Bank of England. So the downward pressure remains on the pound. Of course, the largest factor for downside in the pound that we've seen over the last few days has been Brexit concerns. The Prime Minister Boris Johnson released an internal markets bill in the UK, which essentially potentially walks back the agreement that's already been agreed between the EU and the UK on January this year, and could potentially reopen the negotiation in terms of exactly what the relationship looks like between the EU and the UK. That resulted in further pound selling. So those factors are still very much in the market. So that's why today we still have a downside bias in the pound. Now, the dollar, by contrast, has been seeing some strength over the last few days. This dollar strength since the start of the week has been on risk off flows. And just taking a look at the US dollar, you can see that the US dollar has been sold off heavily with almost unlimited quantitative easing, Federal Reserve keeping interest rates low for 3 years, according to their last FOMC projections. There is medium-term reasons for dollar selling. This big trend line on the weekly chart is now being tested by dollar buyers. So that's why we're seeing a little bit of resistance at this level, which is what we'd expect to see. But this recent dollar strength has come on the back of equity markets falling. Just taking a look at the major equity markets, you can see there's been some heavy falls in the US stock markets, NASDAQ falling heavily. We've also got the German DAX, Euro stocks, ASX 200 and the FTSE 100 over the last few days have been falling heavily. Now, those equity market falls have resulted in strength in the safe haven currencies, the yen, the Swiss franc, and of course the US dollar, which does operate as a safe haven at the moment. That's the reasons for the dollar bids. So this dollar strength is in the market, and that kind of residual dollar strength is remaining. So as a result, we do have a bias today to sell the pound US dollar from any retracements back up to that 1.2813 level. Okay, so any movements back up to that 1.2813 level can be considered suitable for shorting today. Now, the risks to this trade. Number one risk, Michel Barnier has arrived in London today for informal talks. So watch out for Brexit headlines. What we have to be careful of in shorting the pound is that all of a sudden there isn't some positive Brexit news. So say, there's a positive comment, something like, the fisheries problem has been sorted out, the state aid problem has been sorted out, financial equivalence has been sorted out, something like that, with a positive moves between Michel Barnier and Boris Johnson would result in some strong pounds buying. So watch out for that. We need to watch out when you're looking for these headlines. The more influential the person who says the announcement, the greater the impact. So if it's like, a French health minister, or an Italian, a minor Italian minister says, we hope to get Brexit done and we're making some positive progress, that would have very little reaction. But if you had Michel Barnier say something like, we have made good progress in the EU-UK trade deals, that would see some strong pound buying. So if you are looking at shorting the pound or are short the pound, that is the key risk you need to be aware of, is that you don't get any positive Brexit news, and Michel Barnier is in London. The other key news to be looking out for is this. We have the PMI flash services and manufacturing data coming out of the US. Now, if we see a strong beat above 55 and above 56, so if manufacturing flash data comes out above 55 and the services data comes out above 56, expect more US dollar strength. So that would accelerate pound US dollar downside and euro US dollars downside. So that's one key risk to be looking at. The other key risk is here. Now, it comes in the terms of a lot of Fed speakers are speaking. We've had a few Fed comments out already, but we've got Jerome Powell testifying at 3 o'clock. We've got Evans at 4, Rosengren at 5, Bosticks at 6, Kashkari, and a whole swathe of Fed Reserve speakers are coming out. So that is risk for the US dollar. Now, obviously, the Federal Reserve will be looking carefully at equity markets. Now, these falls in equity markets, at the moment, they don't seem too unhealthy to me. So I don't think the Federal Reserve is going to necessarily step in to support that. But at the same time, they don't want to see heavy falls. It's too disruptive. So don't be surprised if they do have some dovish comments to help support the equity markets, and that would weaken the dollar and it would support commodities like gold, and would also support the euro, the pound, and the Aussie US dollar. Here's a little trick to show you. Don't forget that the Australian dollar is very closely related to to US stocks. So if you look here, you can see that this blue line is the S&P 500, and you can see how closely the Australian US dollar follows the S&P 500. But as the S&P 500 tracks higher, the Aussie US dollar tracks higher with it. So you can see here that with these falls in the Aussie US dollar, that has been precipitated by falls in the S&P 500. If we do get some more upticks in the S&P 500, expect that to start supporting the Aussie US dollar. So any further upticks in the S&P 500 should be supportive for the Australian US dollar. And you can see here, starting to get some with price up, the S&P 500 relative to the Aussie US dollar is above price, so we'd expect to see some buyers potentially coming in as long as that S&P 500 remains supported on the day. So don't be surprised to see a little bit of upside. The reason for the Aussie downside has been some negative comments from Deputy Governor De Bell out on Monday, and we've also had a couple of investment banks, Westpac and NAB, suggesting that the RBA will be cutting interest rates. That's the reasons for the Australian weakness, as well as the risk-off tones. That's been weakening the Australian dollar. Although very famous RBA watcher McCann said that the RBA hasn't got enough to cut. There's no reason for the RBA to cut interest rates. So there's a bit of a mixed message going out, but this S&P 500, that's a good indicator. Another good indicator is, I'll show you another little trick, is to look at the bond yield spread. Now, the bond yield spread is when you look at the 10-year bond yield of Australia and take away from that the 10-year bond yield spread from the US, okay? And then when you do that, you have this yield spread line, okay? And essentially, as the yield spread moves higher relative to the 10-year bond yield, it shows you can see here from February that as the Australian 10-year bond yield spread moved higher, that supported the Australian US dollar currency pair higher as well. So as the yield spread moves up, that supports the Australian US dollar pair. As the yield spread moves down, that results in the Australian dollar US dollar currency pair generally moving lower. So as long as that yield spread keeps moving lower, expect the Aussie US dollar to keep tracking it. But if we see a pickup in that yield spread, expect the Australian dollar US dollar pair to follow suit. The yield spread is quite a good way of looking at the different risk profiles of two different nations. And you can see how currencies really track that quite carefully. And here's a swing trade that I've been in for a while that's underwater at the moment, and it's this Australian New Zealand dollar. I've been long from around that 108.68 level, looking for a move up to that 1.100 on a divergence between the RBA and the RBNZ. Now, the RBNZ are looking at opening negative interest rates. The RBA haven't been. Now, recently they backtracked a bit, so I put on the yield spread, which you can see here, which is the yield spread between the Australian 10-year bond yield and the New Zealand 10-year bond yield. And you can see that as this yield goes higher, that's showing you that Australia, as it were, is doing better than New Zealand. So as the yield spread moves up, the Aussie-New Zealand dollar pair moves up. As the yield spread moves down, the Aussie-New Zealand dollar currency pair moves down. And you can see at the moment, you can see that the yield spread is still high, it's above price. And I'm looking for that yield spread to move up higher, and then that should drag the Australian New Zealand dollar higher. I've got my stop running 105.50, and I'm looking for a pop back up towards that 1.100 level. In a balance at the moment, with the couple of negative comments coming out from Governor De Bell and a couple of investment banks seeing negative interest rates, not negative interest rates, a couple of Australian investment banks seeing the RBA cutting. That's why we've seen a little bit of downside. But bond yields are still holding up fairly well. And we've got a good rejection because the RBNZ met last night and they are keeping current plans to cut interest rates to negative next year remains in play. So that's why I'm still happy to keep those Australian, New Zealand dollar longs. But I just thought I'd show you guys how I used the bond yield spread. Very helpful tool. It's the bond yield spread, and it's a good way of analyzing different risk profiles. So there is potentially a long trade that's still in play, and as I said, that's potentially at a bonus. It's at a discount potentially, and you see for a 50 retracement here, you can see that price is just around that 50% fib level. So I'm running a stop underneath the 105.50, looking for a pop up back up to that 1.100 level. So not a bad, a little potential trade there. Just thought I'd sum that up, and that's based on the diverging nature of the RBA and the RBNZ. Okay, so that is the other pair to be looking at is the Euro US dollar. I'll just show you what's been happening with the Euro US dollar. We had an uptick in the Euro US dollar during the session. Now, looking at the economic data out for the euro, we saw a mixed picture. PMI data was going to be important this week for the euro to see if whether that V-shaped recovery is really carrying on. Now, this morning we had services and manufacturing PMI data out. Now, the manufacturing PMI data out for Germany looked better than expected, 56.6, very good. And the manufacturing PMI data for Eurozone as a whole was 53.7, above the maximum expectation of 52.8. That was good. But services PMI bad, below minimum expectations for France, and below minimum expectations for Germany, and below minimum expectations for the Eurozone. Services PMI is the majority of Europe's GDP, so it's a service-driven economy. And also, we have the fact that lockdown restrictions are growing across Europe. So this is a negative. So you'd expect the euro-US dollar pair to be potentially sold on any retracements higher, which is what we have seen. See the movement back up to that 1.1716 level. I was looking for a deeper retracement up into that 11750 level, which you can see is a retest of that weekly descending trend line. So I was looking at any potential move back up to that 11750 level as a suitable area for shorting. I think that remains the case even overnight. Obviously, look out for those Fed speakers, but any deeper retracement 11750 looks suitable for shorting. Okay, guys, that is the key events that we've got coming up, and that's the major things to be looking for. Obviously, we got oil data out as well at 3:30. So I'm just going to go now to the question and answer session and to see if there's any trades you've got or any questions that you just have generally. Yeah, hi, Shrod. Just a quick question. If we see a price break out the trend line, however, price does not retest the breakout point, at this point, what we should do, well, it becomes a judgment call, Schwa. If you are waiting for a breakout to the return to the trend line, that's fine. And sometimes you're going to miss a trade because it doesn't retrace, but that's okay. It's generally, if you obviously get a retracement of the trend line, that's an ideal scenario. So you have to have a judgment call based on the conviction of the trade. CAD Swiss franc short. Okay, so just looking at CAD, first of all, whenever you're looking at CAD, always look at oil. We can see that oil is generally pressured at the moment. Let's just go down. The reason for oil's general pressure is this risk-off sentiment we've been seeing. We had the OECD, IEA reducing demand projections for oil going forward. Libya is starting to get their oil productions back online. Rising COVID-19 cases mean that more and more economies are shutting down, less travel, less oil consumption expected. So oil medium term is a sell. So that should weaken the Canadian dollar. So looking at the CAD Swiss franc pair, let's just CAD. We would expect to see weakness in the CAD Swiss franc. So as long as oil remains pressured, you'd expect the Canadian dollar to remain pressured as well. and any retracements today, you potentially, any retracements back up toward that 0.6920 region, you'd expect to find sellers. So that's what I expect for the CAD Swiss franc. Although you'll be careful with the Swiss franc because it doesn't always operate in a straightforward way. So probably I would prefer the CAD yen because with the CAD yen, it's more obvious that you've got the yen strength. So I would prefer a CAD yen potential short, and any retracement back up to that 79 level, 79.35 level would be ideal in that. Hashik, gold. I hope that some of that helps, Shra. Yeah, gold. Great question on gold. We've seen on gold, look, it's broken out of that symmetrical triangle pattern. The thing with gold, what you have to remember is that it moves inversely to the dollar. So when we have the dollar breaking out to the upside, we have gold falling down. So as the dollar weakens, gold strengthens. So dollar strength equals gold weakness. Dollar weakness equals gold strength. This is the dollar index, which I've overlaid the chart. So as long as the dollar index keeps moving higher, that's dragging gold lower. Symmetrical triangle broken out to the downside. I was looking for a break to the upside, didn't get that. Got a drop to the downside, and my stop was taken out at just under 1900. So medium term, I am still bullish gold, but really you want to see a good retracement back in gold. So ideal kind of level would be around this 1800 level. So looking at this 1800 level to have another attempt at a gold long. So that's what I'd be looking for. Any movement back down to 1800 around this level. Just a little bit above, you can see about 1820. That's the next area that I'll be looking to try to regain gold longs at the moment. As long as that dollar index is rising, expect gold to keep falling. If we get dollar index falling, then we can expect that to be the catalyst to help gold to move higher. And obviously with all those Fed speakers coming up later this afternoon, that has the potential to heavily move the gold market via the US dollar. So that's what I'd say, Hashik. Yeah, Shra, yeah, the support level, you've got this support level here, this minor one, around this 1870 level. So that's possible for a potential long, but just keep a careful eye on the dollar. And if that falls, if that level falls, you could look again at 1820. So it's around market and 1820 are the next two decent support levels for gold. And you can just see the dollar index. Look, it's in this medium-term channel. This is a big trend line above, stay below there, and that's keeping the downside for the US dollar, and that keeps gold supported as long as the dollar index remains below 94.30 odd. Yeah. Yeah, I think, yeah, that's the main things to be looking at. Now, in terms of what's generally going on at the moment, there's a bit of a crossroads going on because we're getting those retracements in the major equity markets, and the market's just trying to find its footing. Now, we're on the verge of another global second wave of COVID-19, cases rising all across Europe, and the potential for a second wave is mounting. On the back of that, we do have hopes of a vaccine coming out towards the fourth quarter. So that's what we need to look at. Now, volume, Shra, you can't use volume very easily in FX markets. Volume you want to use for stocks and shares and indices. And when you're using volume, you want to see high volumes on breakouts to give you an indication that the breakout is real and valid. So that's often how you use it. You can see here when we had this breakout to the downside, and you see volumes rising. When you get volumes rising on a breakout, Shra, it gives you greater indication that the breakout is reliable. So what you don't want to see, you don't want to see volumes falling on a breakout. So if you're looking here, you can see that as price, that's a bit more moot, but you can see price moving and volumes rising. That's what you want to see. You don't want to see volumes falling on a breakout. You want to see volumes rising on a breakout. Generally, that's how you use volume. It gives you that added level of confirmation. But because the FX markets are not traded centrally in the same way that the other exchanges are, you only use volumes for like stocks and shares and the major indices. Okay. Yeah, that's great. Yeah, good, Shwa. I'm glad that helps. Yeah, have a look at this. It's mainly the volumes. That's what you want to look at. And there is a very good book on volumes. It's a book called Technical Analysis of the Financial Markets. Okay, Technical Analysis. I'm just going to of the financial markets, John Murphy. Okay, I'm sending the title of the book, everyone. He writes on volumes, particularly how to use volumes and patterns. Very, very helpful book. And if you get hold of a copy of that book, he'll give a real in-depth study on using volumes, and you'll find it very helpful, Shwa. You may even be able to find some free stuff online, so have a good look. Okay. Yeah, it's a great book. Now, when you order it, get the hardback copy, because you will be using it multiple times and referring to it a number of times. And make sure you get the right copy. It can be quite pricey, so you have to, but it is an investment that's worth getting. Okay, it should be around 40 or 50 pounds, so don't pay any more for it than that. And just see if you can get hold of a copy. It's very helpful. And as I said, get the hardback edition, because you will be referring to it multiple times. It's one of those kind of books that you keep coming back to. Very good. Okay, that's all the questions for today. Thank you all very much. I hope this has been helpful. I hope I've given you some good ideas and a good idea of what's happening in the markets. Just be careful out there at the moment. Got a lot of volatility ahead. So watch yourselves out there. We could get, particularly watch out for Brexit headlines with Michel Barnier in London today. So any pound traders, just watch yourself there today. Okay, folks, thank you all very much. And I look forward to seeing you guys back again on Monday and Wednesday as we get ready for the next day and the next week ahead. Take care, everybody, and have a very good week. Thank you now. Goodbye.